This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it's the effervescent Rob Reinhold.
Effervescent. I've heard that used to describe a soft drink. I don't know if I've ever been described as effervescent, but it's good to be here, and I will be as effervescent as I possibly can.
So for episode 51, this actually, so we started really late this week because of the holidays and travel plans and things like that. So I saw a comment, I think yesterday, on our last episode, asking the question, how much money should we take out of our account? When should we take it out of our account? When is an appropriate time to do that? I'm like, you know what? We actually had this on the spreadsheet. Let's go ahead and do it now. Because I know, if I recall, Rob, you and I have a bit of a difference of opinion on really whether or not to do this at all. So let me go ahead and kind of open things up here. So the overall question is this. You're making money in your trading account, whether you're with a prop firm or you're just doing it by yourself, however you're doing it. When is an appropriate time to actually cash out? And not cash out all the way, but just take some money out. Or should you do it at all? I had always tried really hard to never, ever touch the money I make. I had to sometimes, but over time, there became a point where I didn't have to anymore. And I just let it compound and compound. This works two ways. One, it's almost kind of like a little savings account on the back end there. Two, the bigger it gets, the more money I'm risking every trade, and it gets, and because I'm plus money every year, it gets bigger and bigger and bigger, which is a good thing. Your risk is always going to go up the better you do, but if you keep taking money out of it and cannibalizing those earnings, it's going to be really, you're going to get there a lot slower. So that's always been my MO. Rob, you have a little different take on this and kind of an if-then scenario type overview on it. So go ahead and give us yours, and we'll kind of compare and contrast here.
I really like yours in the beginning. Every single dollar you take out of that account is going to slow down that compounding growth. We did an episode just a couple times ago where we talked about adding money into your account. So we're not just not taking money out, but the positive benefits of adding money, feeding your account to speeding up the compounding interest. So I am 100% with you that in the beginning, as you are trying to grow this pile of money in capital bigger, whatever you can do to get that going faster, you should do that. That should be adding money and then not taking money out. There's no question that that is absolutely the correct answer in the beginning. ... But at a certain point, we need to talk about asset diversification. And I think that's what this episode is going to end up being about. It really comes down to, how much of your net worth is in your one trading account. Now, look, I don't want to be alarmist here, but we do need to talk about some things that have happened. In my trading career, there have been brokerage accounts, and I'm thinking back to 2009. There was a big brokerage firm called MF Global. Now, if you haven't heard of this before, do yourself a favor. Go online, check out MF Global. MF Global was the largest futures, and they did some Forex brokerage in the US, and they were huge. They were absolutely huge, and they basically imploded. They absolutely imploded and lost all the customer funds. And remember, funds held in futures and Forex accounts are not insured by the US government. Now look, all countries are going to have governments that insure and guarantee bank accounts, brokerage accounts, but they have purposely left futures and Forex accounts outside of these protections. And at some point, you really have to start thinking about, I have all of my assets in an uninsured brokerage that if they go out of business, I could lose everything. Now we really have to start thinking about, okay, what do we do with that money? Look, I don't want to be alarmist, but these are the things that you start thinking about when you get more money. It used to be that your bank account was only insured up to $100,000 in the US. And I remember for the first time I got over $100,000 in a bank account, which I thought was the coolest thing ever. I remember thinking like, oh my gosh, this is it. If this bank goes out of business, I'm going to lose everything else up and above that. So all of a sudden, for the first time, I opened up a different bank account and started putting money in there because I wanted to have that protection. I know that is a little bit paranoid, but I have seen things over the years. So it's not really as simple as, hey, let's keep compounding your trading results up to infinity. That's fine. There's nothing wrong with that, and I highly support that. But there's lots of other things we've got to start thinking about to determine how large do you let this account get.
Yeah, well, don't worry, Rob. You're in good company here as far as that goes. If anybody listens to my investing podcast, the 10-Minute Contrarian podcast on Saturdays, you know that I am a diversification lunatic. I have 6 bank accounts. Only 2 of them are in the United States. I have a gold bullion bank. I have numerous crypto wallets. Yeah, it's a good point you just made. Like, I just remember I was listening to this Bitcoin podcast, and the person they were interviewing said that they have 95% of their net worth in Bitcoin. And then the host goes, yeah, me too. And the producer goes, yeah, me too. And I'm like, stupid. I mean, I understand the conviction. I like the conviction. I'm bullish on Bitcoin too. But I don't care what it is. That is an absurdly high amount. So, well, tell me this then. Since I don't do it and you do it, what would you say would be kind of a danger zone amount that people need to be looking at? Say, okay, if my trading account has become this percentage of my net worth, it's time to start trimming it down a little bit.
Now that is the right question for this episode. That is really what it comes down to. You theoretically, as a human being and as an investor and as a trader, you want as much as your money to be in the asset that grows the fastest. So if you only make 12% in real estate, but you make 40% in the business that you own, that's where you want to have a lot of your assets. You kind of want to be over-concentrated there. But as Patrick just pointed out, we also need to be asset allocators and understand that at some point it is too much. So I hope that every single person is either going to do it going forward or has done it in the past, really figured out an overall wealth plan. We've touched on these points over the last 50 episodes where we've talked about, having your net worth sheet at the end of the year. We've talked about growing other income sources. We've talked about diversification. These are all nice terms, but do you have a plan? And so everything should be built off of that plan, and all the decisions you make should be made off of that plan. It's going to be very difficult for you in the moment, after you've had a big run in your account, to decide, should I take money out or should I not? That is most likely going to be a wildly emotional decision. And based on where you are as a trader, in the beginning, you'll say, I'm not taking money out because I just doubled this account. I'm going to triple it next. And then you're going to be an idiot and push too hard and lose it when you should have taken it out. But then once you've traded for a while, you're going to be overly pessimistic and be like, I better take this out early because I've seen this pattern before in the past and I usually give it back. That's a mistake as well. All things need to be done in a systematic manner, just like in trading. So if you don't have an overall wealth plan built, I highly recommend you sit down and do it. And you're going to think about your sources of income. You're going to think about your budget. How much money do you have coming in every month? How much money do you have going out every month? What is your excess? How much of that excess is going to go into investments? What asset category is it going to go into? And then you should have a yearly rebalancing where you look at your net worth. Maybe it's every year, maybe it's every quarter. I don't care what it is. But you look at it and say, okay, do I feel good about where I'm going here? In the stock market, at the end of every year, a lot of major brokerage firms who handle other people's money will literally just go in and look at their portfolio. They're supposed to be 60% stocks, 40% bonds. So let's say this year the bonds did much better than stocks. They're at 45% bonds, 55% stocks. They'll automatically sell 5% of bonds and buy 5% of stocks, bringing them back to 60-40. It wasn't about, is the investment good or not? It's not about, is the chart breaking down or not? It was totally about asset management. So I think you need to run your decisions of when to take your money out based on your overall plan. When is this account going to get too big? Determine it in advance, and then decide how you're going to rebalance it.
Okay. So I know you're rightfully so a bit careful not to put an actual percentage out there because everybody's situation is completely different. But just for an example, for something that maybe people can reference or have something to go on, at what point do you, Rob Reinhold, say, okay, this is becoming too much of my overall account? At what percentage do you think that would be a bit alarming to you?
Ooh, now you're pinning me down here, which I love because I really don't love vague answers and I like definitive answers. Okay, when it comes to stocks, I have 50% of my net worth in stocks. Now that is trading accounts, that is retirement accounts, that is investment accounts. That's what it is. So 50%. But when it comes to trading accounts, 20%. I don't have any more than 20% of my capital in trading accounts.
Okay, good to know. And is there a reason why you think that? Is there a reason why you put that number there?
Yes. In the beginning, it was much, much higher, and I was much, much more aggressive. And what happens is you get a little older, you get a little wiser, and when you've worked your butt off and you've gotten to where you wanted to get to, now it's more about keeping it than it is about growing it. I still want to grow it, but I'm now more concerned with keeping it. So those numbers have gone lower in an effort to diversify my risk profile.
Gotcha. Okay. And this is kind of inspiring to me too, because a couple weeks ago I was going over my overall net worth for this one big reason. I didn't want to have it too big in any one spot because crypto was going up. And I remember last time when it went up a lot, it became an alarming percentage of my net worth. And you really don't want that. So I was kind of assessing everything. And in the process of doing this, I didn't even include any of my trading accounts. That's how passive to me those things are. They're there. It's great. The money's there. I can take it out if I need it. But if I don't, I just want to keep rolling it over and over. But I totally understand your methodology too. So I guess that would kind of lead in to the final question here. And for one, Rob, I'm glad you put that psychological element in there. I was worried this wouldn't be a psychological episode at all, but it is. There are elements to it. How much should you be taking out? And I'm not going to say where should you put that money. I think that might be our next episode. But percentage-wise, how much do you like to take out of that account, and how often would you do it?
All right, great question. Now, this is both a math question and a psychological question. So I'm going to start with the psychological things to consider. But in the end, it's a math question. It's a math question of how much can I take out without killing this account so much that it no longer grows? That's really a math question. I'm going to walk everyone through how to answer that question for math. But psychologically, we do need to talk about a couple things. I remember my biggest goal in the beginning was I wanted a 6-figure trading account. That was the thing that drove me the first couple of years. And so my entire thing was like to get that 6-figure trading account. I wanted to get to that point. And I got to that point. And I remember looking at it thinking, okay, I've worked hard. I want to take a little bit of money out. But then I would drop back down into the 5-figure account. And so I didn't do it. And then I took a drawdown. And then, of course, I kicked myself afterwards because now I was down into the 5 figures again. And it actually started to mess with me psychologically because now all I wanted to do was get back into the 6 figures. That's all I wanted to do. And it stopped being about trading. It stopped being about taking good setups. And it started to being about this arbitrary number that I had put in my head. Now, look, a lot of times in this podcast, we've talked about, look, we all know this is a stupid thing to believe, and you should just not believe it, but we are all human. So I think you have to give yourself a little latitude here that if you have set some sort of goal, like I want to be trading with a 6-figure account, that's okay. That's okay. I know it's stupid. I know it's arbitrary. I know it really doesn't matter at all. But if you said, okay, I'm going to keep this account above $100,000, and every time it gets to $150,000, I can take, $20,000, $30,000 out, whatever it is you decide. That's fine. I wish it was a little bit more scientific and a little bit more based on math, but I fully understand that there are some psychological reasons for you to, quote, keep an account at a certain size. Okay. Next one, there are also some technical reasons to keep your account at a certain size. Let's say that someone is starting out and they are day trading, or they want to be a day trader, but they're running into the pattern day trading rule here in the United States, where any account under $25,000 can only make 3 day trades in a 5-day period, or they get labeled a pattern day trader and they get some restrictions put on them. So this person needs to keep a healthy balance above $25,000 in case they have a drawdown. And then if they have a drawdown, they're going to be now back down below $25,000, and they're going to be possibly in violation of pattern day trading. There's also a style of account called a portfolio margin account. We use these accounts at Maverick Trading. They are awesome, but you need to have minimum $100,000 in the account. If you go below that account, your account immediately switches over to a Reg T margin account, and you'll lose the ability to have portfolio margin until your account is back above 100,000. So we have our psychological reasons, the things we've built up into our brains saying, okay, I don't want to go below this amount. This is what I want to keep in this account. Then we have the technical reasons, things that you need to qualify for in order to keep some of the benefits you're getting. Outside of that, it is simply a math question. How much can you take out without slowing it down too much? And this is where it just basically turns into a math question. The best way to answer this question for you with math is pretend like you are retired. So this is really the same question that retirees have. Retirees have saved up their money. They've allocated money to their 401ks, their IRAs, their investment accounts their entire life, and they've worked at it, and they've been diligent. And when they finally get to the end, where they quit their job and they need money, it becomes a math question. How much can you take out without killing the nest egg that you made? Because if you take it out too fast, the nest egg shrinks too fast, and then the compound interest can't keep up with your withdrawals, and the next thing you know, you don't have a nest egg anymore. You need to just pretend like you are a retiree and say, okay, my trading account is now at $100,000. That's where I wanted to get to. I told myself once I get to $100,000, I'm going to start taking money out. I would like to maintain a 5% growth rate every year in this account, or I just want to break even in this account. Go to a retirement calculator, put in how many years you want to do this for, how much you want to take out, and hit submit. And it will show you, hey, this is what is going to happen. So it's really a math question once you get around all the other things we had to consider. Just pretend like you are retiring, and the question is, how much can I take out of this nest egg without killing the nest egg?
And you touched on this briefly, Rob, but I want to emphasize that, when you're doing this, don't just consider upside, especially if you are a less experienced trader. Making sure you consider that you have a comfortable amount in your account to buffer downside, because that's a thing too. And for some reason, we spent 95% of the show talking about making sure you don't cannibalize your upside. You got to have some buffer in there for downside too. You might have a few bad months, you might have a bad year. And if you took that buffer out of your account to go spend it or go put it towards something else, then that's not really helping you either. I think this is more of a question for more experienced traders that have put some real years in and have now gotten their account up to a pretty nice amount. Would you say that, Rob? Would you say something different to somebody who's only put 6 to 12 months in compared to somebody who's been doing this for a while?
Yes, the people who are 6 to 12 minutes should have just stopped listening to this entire podcast at about minute 5 when we said don't do it at all. That's what they should have done. It's just hit off and gone to episode 52.
And that's what I was kind of alluding to as well. I'm glad you said that, because in the back of my mind, I'm like, oh man, this really is an episode for people who have kind of gotten to a certain point already. Yeah, early on, you should be rolling this over as much as you possibly can. And if you find yourself having to take money out, evaluate why that is and try to get rid of that reason, because you might have started this a little too soon, or you might have allocated too much money to your account, or you didn't take advantage of all the opportunities out there to trade other people's money. So there's a lot of different ways to go. If you've already over leveraged into a trading account, then you're handicapped in a different way that really goes beyond the scope of what we're talking about here. But anything else, Rob, before we wrap this up? I do want to remind everybody that, as far as what to do with that money you take out, you don't just stick it in your ears and celebrate and then do nothing with it. There are smart ways to go with this, and we will be covering that in next episode. But before we do that, Rob, was there anything else that I missed?
Nothing that you missed, but I want to just follow up with what you said. You should try to avoid taking money out of your assets all the time. And not just your trading account, but all of your assets. You want to live off of the money you make. You do not want to live off of your assets, because every dollar you take today is literally $5, $10, $15 you're taking from your future. I know things come up. I've had to dip into my trading account as well. But I really want you to consider, anytime you dip into these accounts, you're taking a loan. And whenever you take a loan out, you got to pay it back. You got to figure out how to pay that back. There are actually calculators out there that will show you how much you are losing over 20 years if you were to take out $5,000 out of your account today. You can go online and you can do the math. And so when you have a situation where, okay, things are a little tight, I get it, and you're looking at this, this trading account over here that's an easy place to go get money. It's a very easy place. It's a click of a button. It's in your account that day. Maybe you should look at other ways. Jump onto one of those calculators and say, okay, if I were to take $5,000 out of this account and never put it back in, what's the difference of where this account is going to be in 5 years? You will be able to see the number. And based on how big your account is, your rate of return, you might see that $5,000 is actually $70,000 in the end after 10 years, 15, whatever it is. I understand sometimes you got to do it. I've been there, had to do it, but I got that money back in there as fast as I possibly could, because I understood that $5,000 is really $25,000 in the end. I got to get that back in as fast as I can. So we talked about, again, feeding your account. We've talked about not taking money out. If you have to take it out, get it back in as fast as you can. You want to live off of your earnings. You want to live off your earnings, not off of your capital. Your capital is the most precious thing to you. You've got to guard that. It's why risk management is so important, because if you don't have capital, I don't care what you know. It doesn't matter. If you lost your capital, it doesn't matter. Make sure your capital is the most precious thing to you. That's all I've got, Patrick.
Yeah, and Rob and I will find a good retirement calculator for you to use, and we will link it down below in the show notes. But that's going to be it for today's episode. Thank you, everybody, for listening to episode 51 of the Trading Psychology Podcast. We will see you next week.
Goodbye, everybody.